Good evening. This is Doc Severson for the Theo Night Report for Tuesday, January 9th. Okay, starting out with the S&P 500 here, we have now triple exhaustion. All time frames, monthly, weekly, and daily are all in exhaustion. And we're closing in on this level on the daily chart where typically we start to see the price go into consolidation. So as we zoom in on this, we can kind of see this, that we've had this several times over the course of the last 12 months where the price will just go berserk like it did into around the end of February last year, right? It got all the way down to that 25 level before it really sort of slowed down and flagged out for a while. And then in late May, early June, we had kind of the same thing, got all the way down there before we had about, 5 or 6 weeks of a flag pattern. And then since that point, we've been consolidating on smaller and smaller breakouts, but this is actually one of the largest moves that we've had, and this follows the pattern of what happens in euphoria. So two things to keep in mind here. First of all, markets that fall, the strongest selling always comes at the very end. And we could bring up silver or just about any other chart that had gone parabolic in the past. But what you'll find is that the strongest gains come at the very, very end of a bull market as well, too. So I'm not saying that this is the very end of it, but we're getting really close to what I think is some corrective price action that will come in the early part of 2018, perhaps as soon as the back half of the month of January. So it doesn't really matter whether we look at the Dow or whether we look at the Nasdaq. So if we look at the Nasdaq, we're going to see about the same signal here. There we go, triple exhaustion, all three time frames. Now the only wild card here is the Russell. As always, the Russell never goes along with the crowd. And so what we're seeing actually is an increasing amount of energy. So this kind of leads to the next point that I want to make is I want to show you what is likely to grind to a halt or at least pull into some type of a flag here in the near future versus what might start to attract the next level of rotation. And really, this is the small caps is going to be one of them because the small caps have done the most sideways price action over the last couple of months or so. And so they have the most potential to continue trending right now. So we might see the baton handed over to the small caps at this point. I'm not going to get into this whole myth about the January effect, but it certainly appears to be in play right now, and we could see it continue through the small caps. All right, so continuing on that theme, what I want to bring up is a scan that I built today. And what I'm looking for in this scan is usually the opposite of what we're looking for. So normally what we're looking for is all these time frames that are coiled up and getting ready to trend. Right, so they're just going sideways, they're building up all this potential energy. And in this market, this is where we're seeing the breakouts come from, as range contraction leads to range expansion once it's built up enough energy. It's almost like a pressure cooker, just at some point the steam gets to the point, builds up that pressure, and it blows the lid off, and up goes the price. Well, let's go find the opposite of that. What I'm looking for here is where the daily chart is in exhaustion, and the monthly chart is in exhaustion, and the weekly chart is in exhaustion. And oh, by the way, let's also look for something that's above its 200-day moving average. So we don't want to look for something that's trending to the downside. What we want to look for is a list of stocks that have gotten a little out of hand. And this is the list that I'm going to expect to see grind to a halt here as we get to the back half of January. So I've got this list set up as a dynamic watch list over here on the lower left-hand side, and I think some of these are going to be no surprise to most of you. Amazon is one of them. Boeing is another one. These are going from top to bottom in terms of price. We have Caterpillar. Again, no stranger to the Dow here. Deere. And then we get into some of the indices, or in this case, the ETFs that we look at. So the diamonds, and here is the DXJ wisdom tree. And then EWJ for Japan, we have FedEx, we have the Qs, we have the spiders, of course, we have Texas Instruments, we have Valero, we have XHB, which is the home builders. We have XLB, one of the spider sectors, and another spider sector here, the industrial, same as the Dow, XLK for technology, and then finally XLY for discretionary. So many of the S&P sectors are in this list as well. So these are the ones that I'm expecting to slow down. So now let's look at the converse of these. What I want to do is I want to look at some stocks that we have that do have a fair amount of energy built up. So actually one of them is Apple. Surprise, surprise, Apple. So Apple is actually flagging out near the top here. We have earnings coming up, let's see, approximately, well, on the 1st of February. So we have a couple of weeks left before Apple earnings. Good chance with all this energy that it's going to try to get a head start on the earnings. So we have AbbVie as well, has been extremely strong, but surprisingly has been choppy enough to build up a bunch of energy. Abercrombie and Fitch, I would not look at this one until it starts to break above this trend line and starts to put in higher highs and higher lows. Otherwise, right now, Abercrombie and Fitch is looking like, just another lower high setting up at a larger time frame. We have BMI, Bristol Myers Squibb, is setting up in a small pennant pattern as well too. We have Citi. So there's a number of financials on here. Citi is one of the better patterns that we're showing. Unfortunately, we have earnings right around the corner. So 116 for Citi, which is next week. CCL, or Carnival Cruise Lines, is another one. Here's Comcast, is setting up with a flag pattern. Delta Airlines, another one of the financials. Goldman Sachs consolidating before earnings coming up. The IWM, so we already pulled up Russell. We said that Russell had a lot of energy sitting there. There's the closing bell. And so the IWM is the ETF of the Russell 2000. And then Coke is sitting in another. This is pretty sloppy though, so I'm not going to look at this one all that much. Regional banks are setting up in a nice little flag pattern as well too. McDonald's, we have MGM, we have Morgan Stanley, another financial. So the financials are really flagging out right now before earnings. So these might make some pretty good earnings trades coming up later this week. Then we have P&G, and then finally TNA. So these are small cap 3X shares, really not something that we want to be playing. Again, there's no reason why not to just play the Russell or the IWM. The last thing I want to bring up for you guys today is I've actually pulled up the profit charts charting package here, and that's it's not something that we use a whole lot. This was the best charting package a couple of decades ago, but has since been supplanted because it's no longer being developed, right? And I think we know the story behind that. But what I like about using profit charts is I will use profit charts as if I want a long time view, because TOS charts only go back 20 years, so I can go back 100 years with the S&P 500 here on profit. What I can also do is I can set it up for log view. So it's important to set it up for log view because you can see, if we go anti-log, you can see how much volatility that we've had in the last 20 years compared to everything prior to that point. So there is something to be said for inflation. There is something to be said for quantitative easing, distorting the current market. So what we have to use is we have to use this log scale for everything now. Now, the point I want to bring to your attention here is, here we are, here's this impossible move that we see going with almost an infinite slope to the upside. But have we seen this guy before? Well, yes, we have. So this kind of puts things in perspective here. Certainly, it's a very strong move. And it's not like any rally that I have traded through over the last 10 years, certainly. But have we seen this guy before? Yes, we have. We've seen this guy before. We've seen this type of slope before. This is the 1987 crash. Here was the entire early 90s all the way up through, there's 98, and then finally to the high in 2000. I recall all the commentary during this. Remember that Alan Greenspan uttered his famous phrase about irrational exuberance, and that was in December of 1996. The market continued to trend higher for another 3.5 years after that. So we've also seen these moves back here in the 50s. Extremely strong moves that we've had in the 50s, early 60s, right? This is not a new story. So a lot of times we'll sit there and complain about this can't possibly be happening, and we get angry because for most of us, we're not long enough, right? We thought this is impossible, but the market can do anything that it wants to. The other thing I'd like to bring to your attention is that we typically do get these types of movements, right? Range contraction for 20 years, and then we have decades worth of trending. We have 20 years of contraction. We have decades of trending. And then we've gone through the same thing here from approximately 99 until the breakout, which was here in 2012, 2013 or so. So I think everybody assigns their own sense of value to what the current market is doing. But I think sometimes going back in history and saying, hey, look, this has happened before. Maybe not in the same vertical scale that we're seeing now. And that's quite evident if we go back to a normal linear 20-year chart. We can see that this rally from 2003 to 2007 that seemed so impressive at that time and seemingly without any kind of pullbacks, that's just a baby compared to what we've been through. So keep in mind that this monster bull market that we're seeing here from the 2009 lows is really comprised of two cyclical bulls separated by a consolidation or corrective period that we had from 2015 to 2016 before the Brexit pushed it above here. And we've been in quiet and trending mode since that point. We are in the second cyclical bull right now. So again, this is very normal. We have to sit back sometimes and get a little bit different perspective on things. It's not the world coming to an end. Usually what happens in these situations is some catalyst will come out of left field that is not already priced into the current mix of stocks and will usually kick off the next correction. Again, what I believe is that we're only due for maybe a 5% correction initially. Those will probably lead to higher prices in the meantime, because tops are a process, folks. Tops do not immediately sell off from the highs. All right, folks, that is it for tonight's report. Thanks for listening, and we'll see you tomorrow.